Hi everyone. Welcome to our channel. In this video we're going to talk about the difference between Forex OTC over-the-counter and traditional Forex. Whether you're a trader or just a beginner in the Forex world, this video is for you. Let's get started. What is traditional Forex? Traditional Forex, also known as the interbank Forex or interbank exchange market, is a decentralized market where currency exchanges take place between major financial players such as banks, financial institutions, governments, and multinational corporations. This is a global market, meaning transactions occur worldwide 24 hours a day, 5 days a week. How the traditional Forex market works. The traditional Forex market is decentralized, meaning it does not rely on a central exchange like the New York Stock Exchange or Nasdaq. Transactions are not processed on a single platform but rather take place between multiple participants who interact directly through electronic networks or private communication systems. Central banks and large commercial banks play a key role in this market. They facilitate currency exchanges for international trade, manage foreign exchange reserves, and sometimes intervene in the Forex market to stabilize their national currency. For example, the U.S. Federal Reserve and the European Central Bank are major players in the Forex market. Liquidity and transaction volume. One of the main advantages of the traditional Forex market is its high liquidity. Liquidity refers to how easily a currency can be exchanged for another without significantly impacting its price. Due to the massive daily trading volume in this market, exceeding $6 trillion per day, currencies can be bought and sold in near real time, reducing the spread, the difference between the bid and ask prices. This creates an environment where there are always trading opportunities, even during off-peak hours. Unlike other financial markets that may experience periods of low activity, Forex remains active around the clock, thanks to different time zones across the globe. Regulation and security. Another important characteristic of the traditional Forex market is regulation. Although it is a decentralized market, it is overseen by national and international financial authorities such as the FCA, Financial Conduct Authority, in the United Kingdom, the CFTC, Commodity Futures Trading Commission, in the United States, the ESMA, European Securities and Markets Authority, in the European Union. These regulators ensure that brokers follow strict standards regarding transparency, risk management, and the protection of client funds. Brokers operating in the traditional Forex market must be registered and licensed by the relevant authorities, providing traders with a certain level of security and trust. This also protects investors from fraud and other abuses that may occur in less regulated markets. Market structure. The traditional Forex market is structured into several segments, each with its own characteristics and objectives. Interbank market. This is where the largest transactions occur between banks. It consists of dealers or traders who negotiate directly, often at the institutional level for very high volumes. Brokers and trading platforms. Brokers play a crucial role in traditional Forex. Although they do not create prices, they facilitate transactions between retail investors and interbank markets. Brokers provide trading platforms that allow traders to access the currency market with leverage and offer tools for technical and fundamental analysis. Retail traders. While the Forex market was historically dominated by financial institutions, more and more retail traders, individuals speculating on the currency market, are now participating, thanks to online brokers making Forex trading accessible. These traders can trade with leverage, allowing them to take larger positions relative to their initial capital. Factors influencing currency prices. Currency prices in the Forex market are influenced by several economic, political, and social factors including interest rates. Central banks set interest rates which directly impact a currency's value. A rise in interest rates can lead to currency appreciation as it attracts foreign investments. Inflation. Higher inflation in a country can devalue its currency because it reduces purchasing power. Geopolitical events. Elections, wars, or economic crises can cause significant fluctuations in the foreign exchange market. Economic data. Reports on employment, GDP, and other economic indicators also influence currency prices. Conclusion. Traditional Forex is a vital market for the global economy. It not only facilitates international trade but also serves as a platform for investors and traders looking to speculate on currency movements. Thanks to its high liquidity and regulation, it provides a relatively stable environment for professional and institutional traders. However, intense competition, high volatility, and the complexity of economic factors make it a challenging market, especially for beginner investors. What is Forex OTC over-the-counter? Forex OTC over-the-counter refers to a decentralized market where currency transactions are conducted directly between parties without going through a centralized exchange. Unlike traditional Forex, which operates in a regulated and highly structured environment, the Forex OTC market functions on online platforms, often accessible to individual traders, making it much more accessible to investors of all levels. This market is called over-the-counter because it takes place outside organized exchanges, such as the New York Stock Exchange or the London Stock Exchange. How Forex OTC works. In Forex OTC, transactions occur directly between two parties without intermediaries like an exchange or a centralized platform. This means that brokers act as counterparties to transactions and are often responsible for setting currency prices. Online trading platforms facilitate these exchanges, but prices may not always reflect the actual interbank market dynamics. This introduces opacity compared to the transparency of transactions in the interbank market, where prices are influenced by a large number of actors and are therefore harder to manipulate. Brokers operating in the Forex OTC market can set their own prices, which can lead to discrepancies between the prices offered by different brokers. Additionally, currency prices can be influenced by market liquidity and trader demand. For example, in times of low liquidity or high volatility, brokers may offer wider spreads, the difference between buying and selling prices, to compensate for their risk. This situation can sometimes make prices less transparent, and price manipulation may occur in certain situations. Less regulation, more flexibility. Forex OTC is often less regulated than the traditional Forex market. While financial institutions in the interbank market are subject to strict regulations from financial authorities, such as the FCA or CFTC, Forex OTC platforms are sometimes based in more lenient jurisdictions where regulations are less strict. This gives brokers greater flexibility to offer attractive products and services to retail traders but also exposes investors to additional risks. Financial authorities in some countries have implemented regulations to protect traders, but these regulations are often less stringent and more flexible than those applied to major banks and institutions in the traditional market. As a result, some Forex OTC brokers may use less transparent practices, making the market potentially riskier. Easy access via trading platforms. Forex OTC is often offered by online trading platforms and specialized brokers that allow individual traders easy access to the market. These brokers typically provide a simplified trading experience with technical analysis tools, high leverage, and a user-friendly interface for beginners. Binary options platforms and online Forex brokers are typical examples of OTC platforms. These platforms allow traders to speculate on the direction of currency prices, upward or downward, over very short periods, minutes to a few hours. This often attracts traders looking to profit from rapid market movements, but it also carries a high risk of quick losses. Derivatives and binary options. One of the specific features of Forex OTC is that it provides access to a wide range of derivative products. Among these products, binary options are very popular. In the context of Forex OTC, a binary option is a contract that allows traders to bet on the price movement of a currency within a given time frame. If the prediction is correct, the trader receives a fixed return. Otherwise, they lose their investment. CFDs, contracts for difference, are also commonly traded in Forex OTC. A CFD allows a trader to speculate on the price movement of a currency pair without actually owning the underlying currency. CFD trading allows for leveraged trading, which can multiply gains but also losses. It is a very popular product on OTC platforms, although it can be risky if not well understood. Liquidity and volatility. Liquidity in Forex OTC is often lower than in the traditional interbank market, which can lead to greater price volatility. Lower liquidity means that large orders can cause more significant price movements, increasing risks, especially for retail traders who do not have access to real-time market information. Additionally, since price manipulation is easier on less regulated platforms, Price discrepancies between different Forex OTC brokers can be observed. These spreads can be wider than those in traditional Forex, especially during periods of low liquidity, which can impact the profitability of transactions for traders. Risks associated with Forex OTC. Forex OTC presents several significant risks, including lack of transparency. Prices are often created by brokers themselves, which can result in a lack of transparency compared to actual market dynamics. Lower regulation. The lack of regulation in some countries may offer less protection for traders, exposing them to less ethical business practices. Price manipulation risk. Brokers can manipulate prices based on demand and liquidity, which can undermine the integrity of transactions. Liquidity risk. Due to lower liquidity, executing transactions quickly without experiencing price deterioration can be more difficult. Conclusion. Forex OTC is an increasingly popular market, especially for retail traders, as it offers easy access and the ability to trade a variety of financial instruments, such as binary options and CFDs. However, it carries significant risks related to its lack of regulation, price manipulation, and sometimes low liquidity. For beginner traders or those looking to speculate over very short periods, Forex OTC may seem attractive, but it is crucial to fully understand the risks before engaging in this market.